Hi, welcome back. Today we're going to look at introducing you to debits and credits within accounting. So debits and credits in accounting are our yin and our yang. Debits are on the left, credits are on the right. When we process transactions, our debits will always equal our credits. When we first start off, simple transactions will only have one debit and one credit. As we build up and get into the more complicated, we may have a multiple debits and or multiple credits. But our total debits will always equal our total credits. This is because of the accounting equation we must always balance. Remember when we looked at the accounting equation, we worked out that our assets plus our expenses equal our liabilities plus our owner's equity plus our revenue. The assets and expenses are on the left-hand side, so debits. Our liabilities, our owner's equity, and our revenue are on the right-hand side, so credits. Debits on the left, credits on the right. Don't try to overthink this. A lot of students starting out try to associate debits and credits as increases and decreases. That doesn't work. A debit will increase some accounts, but it will decrease others. Don't try to think of them as pluses and minuses. It's got the same problem. Some will increase, some will decrease. Some will be positive, some will be negatives. So a debit can operate both ways. Don't try to think of them as good and bad. Don't try to think of them as Marvel versus DC. Just as silly when you get to know it between the differences between debits and credits. All it is debits are on the left, credits are on the right. As we can see, our assets and our expenses are on the debit side of the accounting equation, so we call them debit accounts. We expect them to have a debit balance. We're going to increase them with a debit and decrease them with a credit. Conversely, our owner's equity, our liability, and our revenues are on the credit side of the equation, or the right side of the equation. So we call them credit accounts. We expect these to have a credit balance. We're going to increase them with a credit and decrease them with a debit. So you can see there that a debit account we increase with a debit, and a credit account we decrease with a debit. So that's why it's so important. You just think of them as a left and a right, because a debit will do different things depending on the type of account. We can summarize it down to this. We have our 5 different types of accounts that we've talked about. Our assets, liabilities, owner's equity, revenue, and expenses. And we've gone through and we've got our definitions for those. We know that our assets are things that we own. Liabilities are what we owe. Our owner's equity is our capital plus our profit, or less our loss, minus any drawings. Revenues are what we have earned, and our expenses are our costs of doing business. Now we can expand this now to include our increase and decrease, whether it's a debit or a credit. So we increase our assets with a debit as we do with our expenses. We increase our liabilities, our owner's equity, and our revenues with credits. If you can remember the order, top and bottom is a debit, everything in between is a credit. A bit of a cheat's way of remembering it. This is important. This is the key to accounting. If we're struggling with accounting, it's probably because we don't understand this concept. So this is really important to make sure that we understand. Next video, what we're going to do is we're going to have a look at applying that to some transactions, and we're going to look at what I call the 4 Qs, or the 4 questions, how we work out what is the debits and what is the credits of a transaction. I'll hope you join me then.